Yo, what's going on everybody, and welcome back to the channel. And today we're going to be talking about the fractal nature of using stage analysis and kind of how those key moving averages play when we are dropping down to different time frames. And this video is going to spur from a great question that I had from a subscriber, and we'll read it here. So Sydney said, given the volatility of crypto, I've changed my strategy during the latest decline from using weekly candles to using daily candles and the 20-day moving average, which is also what I use. My understanding and experience has been that given stage analysis is fractal, and wondering if you think that using a longer term time frame like 30 or 50-day moving average might be more suitable when using daily candles. I've changed my methodology, which makes me a bit uncomfortable based on how explosive the upside and downside breakouts can be in crypto. I'm hoping to catch the upside breakout when it eventually comes and prefer not to entirely miss the surge. I'm not trying to catch the bottom, mind you, but am trying instead to avoid missing out on a 50% breakout weekly candle, which is always possible. Any thoughts would be appreciated. Cheers. So this is a great question from Sydney, and let's dive into the charts and look at it. So here's a chart of Bitcoin. This is your weekly chart, and I'm going to throw on the 20-week moving average, which is what I use when I'm looking at stage analysis on the weekly time frame. And then I'm going to hide that, and then we'll look at the 30, which is what Stan used. And then we're going to hide that one and throw on the 50, which is what a lot of other traders use. So throwing them all on at the same time, as you can see, the 20 is the green, the 30 is the blue, and the 50 is the red. So the first thing that should stand out to you is the fact that the 20 period moving average is much more sensitive to price compared to the 30 and the 50. It will react faster than the slower term moving averages. So since it only has 20 days of price within its calculation, it's going to be more sensitive to those moves. So as you can see, when we first broke out here back in April of 20, the first moving average to get taken out was the 20-day, followed by the 30, followed by the 50. And then when everything broke down back in May of 21, price first broke down below the 20-day, then the 30, then the 50. So this is a pretty big discovery. If you're looking at this here, those shorter term moving averages are going to be much more sensitive to price just through the fact that they have less data within their calculation. So let's hide all those, and then let's drop down to the daily chart and look at that 20-day moving average like Sydney was saying they're using. So Bitcoin hasn't been very great on the upside following the 20-day moving average, but it has been great following it on the downside. And as you can see, we'll take this April level for example. Once we broke down, we did get this intraday penetration, and same thing over here, but pretty much all the way through the end of May, price was respecting below the 20-day moving average, which is what we want to see. And going back to Sydney's question, so they're hoping to catch the upside breakout when it eventually comes and prefer not to miss the surge, but they're uncomfortable using the 20-day because it is more sensitive. So Sydney, I don't know how long you typically hold your trades. I don't really know your selling rules, but I personally do use the 20-day. I do find it follows price much better than the 30 or the 50. And let's take a look at the 50. So, you never really got a great shorting opportunity here. You kind of had this level right here, but if you're going to be using these longer term moving averages, then you really have to depend on support and resistance much more. Just because you can't blindly kind of trade based on price above green line good, price below green line bad when you're using that 20-day moving average. Just because, if you wanted to short here back in June, you wouldn't have had that opportunity because price was so far below. And then same thing on this May level. You never really got any great shorting opportunities using the 50. And that's why I like the 20 so much more, just because it is more sensitive. You do get more signals. So, sometimes if you're purely just trading on price above or below as far as your signals on a moving average, you're going to get more whipsaws. You're going to get stopped in and out of your positions more often if you are using those shorter term time frame moving averages. But as long as you have defined rules and as long as you always stick to those rules, you're not really going to have an issue long term. So let's see if I answered everything in here. If you're feeling uncomfortable with all the signals you're getting, maybe just kind of try to refine your strategy a little bit. Maybe don't purely buy based off price above good, price below bad. Maybe try to mix in some, maybe some ATR offsets to kind of give you a little buffer between that line. And maybe try to mix in, hey, price is above this line, this moving average, let's also get it above a resistance, and then that's kind of how you buy your breakouts, and then maybe the opposite for shorting. But that's kind of my opinion on it. I really do love the 20-day moving average, and I do predominantly trade using this daily time frame. I'll try to get big picture using the weekly, and then I try to hone in on my buying on this daily chart, and I do that using the 20-day moving average and a mixture of support and resistance with many other factors, but trying to keep it simple here. So Sydney, watch this video. Let me know if you have any other questions, and thanks everybody for watching. I'll make sure to add this one to the stage analysis. Bye.